Conley is back on CNBC today and dropped another massive bombshell. He says small caps could outperform by more than 100% in the next few years.
It's now in the markets. Tom Lee, head of research at Fundstrat Global Advisors, chief investment officer at Fundstrat Capital. The list goes on, and he's a CNBC contributor. First post-election appearance that we've had. You knew Trump was going to win.
Well,
not many people did.
Yes, that's.
I'll give you credit. Are you saying you didn't? Maybe you didn't say it in so many words, but you said it.
Yes, I'd say that we were placing a lot more weight on what the betting markets were pointing to, and so and we, when we look at all the deltas,
and you saw it in the Trump trade,
yes.
And you saw it in Bitcoin,
correct,
and you saw it in sectors of the market that would benefit from.
That's right.
Presumably, but who knows from a Trump presidency. So 1,500 points a meet out of the gate. More to come, or are we're already there?
I think we need to respect this move. I mean, there was a tremendous rally post-election, and it continued yesterday. I think it really does reflect a lot of money was taken out of the market because of the uncertainty around the election. And now we know that because of policy changes and animal spirits, that this is really going to benefit things like Bitcoin and small caps and regional banks and financials. So I do think there's still a lot of upside. I mean, small caps trade at 10 times median forward earnings. I mean, that's a...
So what do you think that should be, 12 times? I mean, what's the opportunity set in your mind?
Well, since 1987, small caps traded on a median PE basis at a premium to the S&P. The S&P is at 17 times. So I think small caps could, in the next couple years, outperform by more than 100%.
And what do you think about some of the macro issues that I think create a different level of uncertainty? We keep talking about the bond market and what that might be saying, what you think is happening with gold. Are the bond vigilantes going to be this governor on whatever you think is going to happen in Washington?
As James Carville famously said, the bond market is, everyone's scared of the bond market. So that is something we need to watch. But we've had plenty of periods where stocks have risen with bonds rising. And I kind of agree with Powell's assessment that it's not yields have gone up not because of inflation, but because there's sort of a change in growth expectations.
I thought that a sweep was, for either party, was the death knell for the markets and frightening to all involved. And now we're getting a sweep. Why isn't it more frightening? Maybe the sweep the other way would have been a little more frightening to some.
Yeah. I mean, I think part of the reason investors are getting somewhat optimistic is that President Trump is entering office again, but this time with a lot more knowledge of how to build a cabinet and a team. And so in some ways, this would end up being more market friendly. And I think that's why investors are becoming optimistic. I mean, I kind of agree with the idea that there are animal spirits growing.
He'll never be deficit friendly, will he? I mean, he will be deficit friendly. He won't be, if we cut taxes on tips, Social Security, overtime, remove the SALT cap, extend the tax cuts. If you do all those things, that seems like...
It's going to be very difficult to fix the deficit with just changes in taxes and spending. But it's probably why Bitcoin is kind of interesting here, because it's potentially a treasury reserve asset. And, if Bitcoin rises in price, it actually helps offset the liabilities, which is the deficit.
So you were at 150, I think, on Bitcoin, weren't you? But
yeah.
Not necessarily by the end of this year, or?
I think 6 figures is still possible for it before the end of the year, yeah.
And then more next year and the year after?
Yeah, I think because now, post-halving and now Bitcoin's becoming a lot more relevant, and I think maybe the regulatory overhang is diminishing, that there's a lot of upside from here, yes.
Okay, S&P, end of next year.
Well, between now and year end, 5 to 10% is probably the base case, just because that's the type of rally post-election, and we have a dovish Fed and, the normal seasonals.
Is that the right move right now for the Fed?
I think inflation fighting war is largely over, and the real rate is still too high. So I agree with Fed's view that we need to move towards neutral, which is towards 3%. So I think it is supportive of markets, and business investment has been constrained. So I think these things are positive.
So what about 2000? What's next year? Is that 25? They move so fast. They're like months now, the years. So what about 2025? So 5 to 10% more would put us well above.
Yeah, more than 6,000 before year end. I think at least for the foreseeable future,
No recession.
no recession,
And people want you to answer when I ask you a question. So what are you saying? 60, what hundred on the S&P?
I think well past like 6,700.
No.
Sometime next year.
6,700?
Yeah, sometime next year because
That's another 20%, isn't it?
Yeah, maybe 10, 15. Yeah, because margin debt hasn't really risen in the last 4 months, and the stock market's up. So we know investors haven't been adding risk, and now we have earnings visibility, and we have a continued dovish Fed, and then this election's behind us. So multiple tailwinds exist.
Wow, you're pretty bullish.
I think I'm pretty positive on the U.S. and fundamentals, yes.
So yeah, I think the commentator there covered it very well. Tom Lee, just to summarize it, is very bullish, expecting 5 to 10% higher from here into year end, and then the S&P could go much higher into 2025. In fact, I would throw something else on there. If we do have a soft landing, if earnings do come in better than expected, let's say 13 to 15% earnings growth next year, by the end of next year, you could see the SPY at 700. That is possible. Now, in the book that I'm reading currently, or rereading, I should say, called The Psychology of Money, there's something interesting that really stands out to me within that book. The book talks about how everyone has different views of things, okay? Some people are day trading. So in the book, it referenced Cisco in 2000. At Cisco's market cap, that was like $600 billion. Cisco, over 20 years, so today, at the implied rate of growth Cisco had then, would be worth more than the entire US economy. Like, everyone knew that Cisco was a trade. It was not a long-term investment at a $600+ billion, company then. And think about $600 billion company then was like, $3, $5, $10 trillion in today's, nominal values, right? It was egregious, but everyone loved the stock because they were trading the stock. Okay. When you start to get expectations of investors that switch more to traders from that perspective, markets can go dramatically higher and valuation does not matter. So I talked about this on the channel before where I said valuations do not matter. Yes, valuations matter to a certain extent, but the psychology of investors changes from a market where, let's say in the 1960s, 70s, 80s, where investors invested for the long term. They looked at price to book. They looked at, all these other metrics that, let's say, Warren Buffett has written about before, or a Graham, right, has written about before. And those ways of evaluating stocks just don't work because now there's long-term investing perspectives like, hey, I don't want to pay more than 20 times earnings for this company, right? There's still that goes on, but more people have switched to near-term momentum and riding trends. When you get that kind of behavior, nobody rides a trend, let's say in Tesla that's up 10% today, based on multiples. That's not the deciding factor whether or not you make a trade on Tesla is what the multiple is, because if that's your metric of evaluating a company, Tesla's multiple does not fall in your peripherals, right? You guys get the word I'm trying to say. It doesn't fall in your area of, the markets, right? So you're getting a lot more people that are starting to say, hey, maybe there's a trend here. Maybe there's a trade here. And then over time, that can evolve into, wow, this company actually did well. That company actually did well. That was a good trade, turned to a longer term, investment or longer term trade. And that's what you could start to see happen. investors flipping from, and they don't even realize they do this, right? They don't even realize that they go from long-term investors that care about valuations to more short-term trend, followers that don't necessarily care about valuations, right? A day trader doesn't care about a valuation. They're trying to get in, they're trying to get out. Investors switching from investors to, momentum traders that buy a stock and hold it for a couple of months. It almost happens without you even realizing it, right? And you might fall in that category. 10 years ago, you may have been someone that bought a stock and held it. Today, you could be someone that buys a stock until the trend changes, until the company gets worse, and then you sell the stock, right? That's more of what you're seeing. For those reasons, I don't think you can solely rely on valuations and say that's the ultimate kind of stopping point for markets. Hopefully that makes some sense. Let me know what you think down below in the comment section. That's what's great about investing. We all have our own opinions. Now, here today at 10 o'clock in the morning, we did get Michigan consumer sentiment. That came in at 73.0. The expectation was 71, so that was good on the headline number. 5-year inflation expectations crept up to 3.1%. They were at 3%. They've been going back and forth from 3% to 3.1%, so really not a big deal. Consumer expectations jumped dramatically following Trump's win of the 47th spot of the President of the United States, jumping from 74.1 to 78.5. Current conditions fell marginally from 64.9 to 64.4, and inflation expectations over the 1 year ahead period actually fell as well from 2.7% down to 2.6%. And I do think as kind of a broad brush statement here, as people start to see the change in gas prices at the pump over the last couple of days, oil prices have fallen, presumably gas prices will also fall, they may get even more optimistic, and that could be great news. As you can see today, oil is down about 2.71%. With that said, option activity today in the SPY, which is the ETF for the S&P 500, is pretty neutral today, which is actually good relative to what we've seen over the past couple of days. You have 254 different hedge fund institutional option orders on the SPY specifically, totaling $187 million with a positive order value of 51%. So again, that's actually a pretty good ratio. We've seen numbers in the 20s and in the 30s over the past couple of days. Now, if you look at the shorts, there's still 10.2% short interest of free flow on the SPY, and it does look like in the days ahead, if the markets do break above 6,000 on the SPY, you're probably going to see a lot of pressure on those shorts to start covering some of those short positions. Now, personally, I think we have a pretty good setup between now and the end of this year from a perspective of the Fed is cutting rates, economy's okay, earnings just got out the way. Over the past week and a half, we've gotten a jobs report, we've gotten inflation ratings, we've gotten all of this data. Again, we just had the Fed's commentary that was really bullish for treasuries. You have Trump now going to take over in 2025. You could definitely make a strong case here for an upside continuation. It's actually pretty hard to make a bearish case right now, excluding valuations, right? Exclude valuations because they don't matter in the short term. People don't wake up one day and say, I'm going to sell this stock because it's above a certain valuation. Generally speaking, that induces more buying when a stock is doing well and the valuation is going higher. Nonetheless, I mean, besides any kind of fluke, headline that Trump's going to do this or Trump's going to do that, or a bad set of economic data, it's really hard to make a bearish case right now. Now, our market's going to go straight up in a line forever? Obviously not. You've seen markets pretty much go straight up over the past 3 days now. Great news for your brokerage account and your 401ks, largely speaking. It's actually 4 green days in a row where you have collectively went up on the SPY about 5.5% or so. That's some pretty strong momentum, and I'm not going to be surprised if it continues. But at some point, you will level out a bit. You will see volume on the SPY fall which you kind of are seeing today. And you will see things go back to a little bit more of a normal market, and then we'll get hit by headlines, positive or negative, from Trump, I think is going to be a big source of market moving headlines. So we'll see from that perspective. But as you head into a seasonally bullish period in time of the year, there's just not a big bear thesis. So if you are short right now in markets, please, I don't often tell you please on anything, but please be very careful. It's hard to make a bearish argument. And I'm a bear by nature. Like most people are optimistic by nature. I'm like always looking for what's going to go wrong, at least in the short term. I'm bullish long term, but I tend to be a bear in the near term. I've just learned that about myself. It's helped me, prepare for times in the markets in which it helps to be a little bit more bearish, like the end of 2021, like COVID in 2020, right? Like the trade war situation we had going on in December of 2018. Like these times, my short-term bearish subconscious or conscious, I should say, has helped a lot. And that's, why I hope you guys watch this video to get some warning, some heads up of rocky times ahead. But I just don't see that right now. Of course, are you going to have down days? Yes. But a correction here, any kind of material downside, does not seem likely to me. But a good leveling out, some sideways trading, is to be expected at some point over the next couple of weeks. And then probably you will see a year-end rally from there. Although you have a lot of funds underperforming the S&P, with all of the good going for markets right now, you could start to see a chase and you could start to see a bit of a short squeeze. So be on the lookout for that as well. That is going to do it, ladies and gentlemen. Let me know what you think about this information down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.